Today we'll talk about Chapter 15, Competition Policy and Regulation. We'll go through industrial concentration and why governments combat it, the economic principles and difficulties about prices, rates by national monopolies, and the nature of social regulation, its benefits and costs at optimal level. So industrial concentration exists when a single firm or a small number of firms control the major portion of the output for an industry. Competition policy, made up of regulatory agencies, competition law, merger types, and competition law. So there's horizontal mergers, which you purchase companies that are competitors of you. Vertical mergers, you purchase a supplier, you purchase a distributor, and you have all of them owned by the same company. And conglomerate mergers, when you purchase different companies in different industries. Merger guidelines. Horizontal merger. That's when you merge with companies in the same industry. So banks coming together, merging. Vertical merger, when you purchase a producer or a distributor. Price fixing is when you work with another company to set prices high. So you coordinate with another company, probably in your own industry, to set prices high to maximize profits. And they usually set prices where marginal revenue was marginal cost. Then price discrimination is when the company sets prices equal to the willingness to pay for each person. So that allows for maximization of profits. So price equals willingness to pay. And they use consumer data to determine the highest price you will be willing to pay for a product, and they charge you that price. So Facebook and many other social media companies collect your data, and advertisers use that data to provide the highest price they can charge to you. Yeah. Tying contracts. So the seller requires a buyer purchase other products from them as a condition for buying a desired product. So there's a prohibition of tying contracts. There's been non-challenged mergers, including Fording Inc., Tech Comico Limited, Luscar Limited, and Consol Energy Inc. Attempted mergers blocked include Royal Bank of Canada, Bank of Montreal, CIBC, and TD Bank, because these mergers here would be anti-competitive, and they would have too much market power. There would be too much. They would be able to charge too high prices for consumers, and it would be very, very inefficient and cause a lot of problems with high prices for consumers, and it would hurt our overall economy. It would only benefit producers. So trade-offs among goals. The competition laws enforcement, it may reduce emerging new technologies. And there's a good question, should the government temporarily suspend competition rules to encourage restructuring of industries and speed up the expansion of this new technology? That's a good question. I would say no, because competition is good for our for technology growth, because if there's not enough competition, like in the Rogers Bell example, the product suffers. So Rogers has Rogers and Bell and companies in the telecom industry don't have enough competition. Therefore, their product therefore they don't have incentive to innovate. We need competition because competition provides an incentive to innovate, because they compete on price and product quality. But yeah, if you have a different answer, feel free to state that. The natural monopoly, Economies of scale are extensive, so if a single firm can supply the entire market at a low enough unit cost. Improving on outcomes, public ownership can help with this. Public industrial regulation is the preferred option. Public interest theory of regulation, industrial regulation is necessary to prevent monopoly prices and harm consumer society. Regulated firms have no incentive to reduce operating costs, perpetuating monopoly. Regulation can sometimes perpetuate a monopoly long after the conditions of natural monopoly have ended. Legal cartel theory, occupational licensing can provide for this. Deregulation, there's been a lot of deregulation since the 70s through airlines, trucking, telecommunications, etc. There was a lot of deregulation in the financial industry during 2008 that caused a lot of issues with providing loans to subprime borrowers and using a lot of derivatives to bet against these loans, and that caused a massive recession. And then in the 60s, a new type of regulation began to emerge. Social regulation focused on the concerns which goods and services are produced, impact of production society, and physical qualities of goods. So distinguishing features applies to many firms, intrudes into the day-to-day production process, expanded rapidly. The optimum level of social regulation, marginal benefit equals marginal cost. So social regulation, there's a lot of good reasons. There's notable successes. It goes against some problems and solves some problems. It's expensive, but it's worthwhile. Social regulation, the problem with that is the marginal cost is greater than marginal benefits. Laws are poorly written, standards are difficult to understand, there's overzealous regulators. So there's no free lunch. Social regulation can produce higher prices, stifle innovation, and reduce competition. Less government is not always better than more. Although the market system is a powerful engine for producing goods and services and generating income, it has its flaws. So antitrust, there was price fixing, and the U.S. airlines was price fixing with current and future prices, and colluding happened. So they were setting prices to maximize profits, and this was a problem. And what Microsoft did was they allowed for Windows to run Internet Explorer, but it wouldn't be able to run Netscape Navigator. And this was very anti-competitive because they weren't allowing Netscape to run well on Windows. And they were fined $2.7 billion for antitrust. Google, they were favoring its Google Shopping price comparison service in the search. And the European Union intervened to stop them from using the monopoly to favor its Google Shopping price comparison service. And then, colluding maximizes profits, which provides producers an incentive to collude, but it's still a problem.